So the average person has a lot of problems to understand value investing. One problem is our feelings and emotions. Value investing means you buy usually against the crowd, against the herd. You swim against the stream, and that is very difficult because usually you invest like the perfect situation is a crash, a panic, a catastrophe. You invest then, and even you buy pretty much on a down, on a stock that is down, you never catch the perfect moment. So after you bought it, it will probably with a high chance go even lower, and so you will create a loss on a short-term basis or even for many weeks or months, and that's the difficult thing. Another problem is that you want to catch quality stocks, and that's what Warren Buffett is doing. He waits for a bad crisis, for a crash, a catastrophe, and he buys then wonderful companies with wonderful management, with a wonderful management that is ethical, good, where he has trust to. And that's another problem what retail investors have. They go for short term thing, or they like trends, they like hot stocks, they like, and he goes for quality things you can predict long term, and that companies that exist for let's say 100 years or at least 50 years, like old oil. He likes like Procter and Gamble, or like all traditional Wells Fargo, traditional companies where you can predict the next 5 to 10 years easily. He wants dividends. A lot of people buy technology, they buy social media that doesn't pay out dividends, and that gives stability to Warren Buffett. The dividend he gets every quarter, his paycheck into his account, and that what counts for him. He wouldn't buy probably Twitter or Facebook because there is no dividend. And another thing about value investing is then once he has bought it in a terrible market, he can hold on to it even if it goes below his price he paid, and then he has an extreme patience. He holds them for many decades or even forever. Like companies I mentioned before, Coca-Cola, Wells Fargo, ExxonMobil, IBM, many years or many decades. American Express, I think since the 60s he bought American Express, and so he doesn't want to sell it, he keeps it for the long run. And that's also a problem what retail investors have. They have no patience, or even professional investors, fund managers, they hold on to their stocks. The average holding period is below a year, so they have a lot of turnover in their portfolios. That costs money, that destroys the benefit of the compounding. And retail investor may pay also taxes, other fees on it. And so that's the good thing about it is when you look at Warren Buffett's strategy, it is you buy in a bad market situation. You can wait. He has a lot of cash to wait for it. He buys when the market goes down. He's not worried when the price goes even further down. He waits it out, and he never buys it on the perfect on the perfect 12 months low. The stock usually goes further down, but Warren Buffett keeps on buying. He has an extreme patience, and he sticks to it for the long run. And he has the cash to use situations like a crash. But that doesn't mean for a retail investor to hold on to a lot of cash, because the inflation is a problem. Of course, you should invest. You shouldn't hold on to too much cash. Warren Buffett also has to do it because he has a lot of insurance businesses, and the oversight, the risk situation needs. It is for him. There is a duty to have cash and cushion because regulation asks for it, and he has a reinsurance business. He has Geico. If there is something happening, a disaster, a hurricane or so, he has to have the cushion. So if there wouldn't be probably so much regulation in the insurance business, I think he would have had invested more into the stock market. But because of the regulation asked for it, he buys bonds and has a huge cash position. And because of the need of the regulator, also he wants to wait for a good moment, of course, and he wants to be flexible and react on a crash or so. So to summarize it, what is important? Focus on quality companies. Focus on those one you can predict long term. Once you buy them, keep them for the long run. Watch out for good management. Trustworthy people. Watch out for dividends, and if the stock market goes down, add onto your positions, and just go against the herd. Go against the mainstream. Okay, that's all for today.